Well, good morning. A quick look at the numbers. No surprises in the ISM survey. Nothing exciting in jobless claims, and unemployment is still 5%. Those of you that watch the yield curve have probably noticed that it has adjusted and shifted down again and had no market impact whatsoever on the Fed raising 25 basis points. Not surprising. And 30-year mortgages are back down below 4%. Hence the surge in new mortgages last week. That 4% is a magic number for those looking for new financing. The federal deficit is still looking good. It's still declining, though this month has had some impact on that. Overall, it is clearly declining. In many ways, this is due to almost non-existent need for government borrowing. Some of the assets purchased in 2007 are already rolling off. And we got Congress to address some major fiscal issues, which I thought was really great news. The doc fix for Medicare payments. They suspended the debt limit until early 2017. The 5-year transportation bill was a huge boost if you work on highways. Several tax breaks were made permanent, and subtly the caps on discretionary federal outlays for 2016 and 17 were made permanent. Sequestration does have an impact. Debt is some of the issue going on in the markets today, and we'll get to those in a minute. On the personal side, total consumer debt is now about $3.5 trillion. Credit cards are holding steady at $900 billion. The only two sectors that are expanding are auto loans, which are about $1 trillion right now, which is really the hottest market there is right now, is buying cars. They're adding about $1 billion a month. And student loans are at about $1.3 billion, which is a huge number given its history, and growing slowly. Mortgage debt side of things, it's still shrinking. In 2000, there was about $383 billion in what we call today low-quality mortgages or no-document mortgages. And by 2007, that had grown to $2.2 trillion. Explosive growth before that market melted down and precipitated a very interesting 2008. Today, we're at about 632 in mortgages and dropping $100 billion a year. The mortgage market is clearly shrinking. In 2000, there was about $407 billion in line of credit debt, and by 2007, that was $1.1 trillion. It's now down to about $644 billion and shrinking.
Why is it shrinking?
People are paying off their debt. People are not borrowing more. That is a trend. Some of the savings numbers, when they don't go to spending, they go to paying their debt down. The spending in December was down a little bit. Nobody's surprised. The, quote, Christmas spending was flat, if not down. Paying down line of credit, that happened. Paying down mortgages, that happened too. It's a fun bunch we have in the economy right now. Job market continues to improve, and I'll put improve in quotation marks. This side here, finally, the Bureau of Labor Statistics came out with where the jobs are improving. And the important part here is the mid section, the orange section. The low is strictly minimum wage, and that hasn't changed much since 2011. But the, about the $28,000 to $65,000 salary range is expanding reasonably well. Entry level into health care and a few other places. On the other side, this is the banking industry, and this is the percentage and the thousands of jobs lost since 2008 up to 2015. Notably, the two biggest losers were naturally Citibank and Royal Bank of Scotland. Who is absent here is Wells Fargo, who just took over and passed Citibank in total assets a little while ago. Very different organization. These losses reflect changes in trading, securities desks, broker-dealer operations, things that sort of bit them kind of hard after 2008. And those positions very likely, even with Deutsche Bank, very likely not coming back. More on that later. The press is coming around again and saying that the middle class is vanishing. Well, okay. This is share of income, by the way. The, quote, upper income, I think that's at about $265 annually right now, has passed the middle income here recently. The lower income has not changed. It hasn't changed since the 70s as a percentage. Like they say, the poor will always be with us. But the numbers of the middle income and the upper income have shifted. Of course, the fact that that upper income number has not shifted in a long time might have some impact on that. But middle class isn't vanishing. They're just getting in a tighter band, while the upper income is expanding. Again, we've talked about this again there at the very top. The strongest market out there right now is motor vehicles, non-store retailers, and food services. Joel's analysis that everybody out there is out spending their time and money in restaurants, well, they're doing it and getting there in a new car. Everybody else is basically flat. This goes back a ways, but it's very indicative of how the spending patterns have been impacted by inflation. Well, they're not. They're flat. They're very consumer-oriented, and obviously the one that stands out most here is gasoline stations. I'm really not surprised that they're weak, but department stores especially and shopping malls are headed down. That retail beast is starting to see its waning days. Everybody's seen this. This is what the S&P has done here in the black versus what the federal funds have done, and we've seen this before. Considering what's going on in the market today, here is the S&P 500 for the last 2 years. It hasn't done anything. It's up about 3%. I wouldn't read much into the drama of, gee, the S&P is down and the markets are coming apart. Well, no, they're not. We've had almost 3 10% down days in a row in the last 2 years, which is very unusual, but it still has a great deal of support underneath it, and it's a market moving sideways. If you pull the S&P earnings and take a peek at them, the S&P 500 earnings that are energy and materials, steel and aluminum and copper, and the oil companies, well, their earnings are down 14%. Shouldn't be surprised. The rest of the S&P 500, outside of energy and materials, is growing at 6% quite well. We have some impact on some very strong members of the S&P 500 now that oil is at 28, and we could see it at 22 here in the next 30 days, now that Iran might be entering the oil market. Spreads have widened in some places. Here's the spreads mostly on the high yield, and it's pretty clear that the energy-related and some of the materials-related bonds have widened out a little bit. There's a little fear in the marketplace that there will be more and more bankruptcies in the energy patch. There very likely will be. $30 a barrel is a critical number for a lot of smaller producers. And the rampant acquisition that was rationalized as being their salvation is not happening. A lot of the oil companies really aren't interested in having more of what they already have. But the spreads have widened. The BAA spread has widened a little tiny bit. Some of that is fears based on bankruptcies or that energy will never recover. I mean, there's a lot of reasons. Personally, I think it's more liquidity in that marketplace. The TED spread, which, of course, is treasuries against Eurodollar loans, high-quality short-term loans. In the media, if you look all the way to the right, TED spreads, have really widened. Well, in the overall scale since 2007, no, they haven't. Some people have determined that the European banks are in trouble and don't understand what's going on in the world. Well, I don't buy into that. But the spread has widened a little tiny bit. It just has nothing to do with how some of the equity markets are reacting around the globe. They're just disappointed. It's not a quality issue. Here is the bulk of the ball game, and I know this is a review for some of you. This is what's affectionately known as the Federal Reserve balance sheet. This is about $4.3 trillion of what would ordinarily be bouncing around in the bond market. These are treasuries, these are agencies, these are AAAs, AAs, single A's, everything they could get their hands on when they were doing the quantitative easing. That's how they put all these excess reserves in the banks. That's how they cleaned up all the worry in the market. That's how they provided liquidity to all those that were weeping. This is a pretty high-quality portfolio held by the Federal Reserve, and it's real assets. Never talked about very much, but there's two ways for the Federal Reserve to raise rates. One way, which is what they're choosing to do right now, is simply raise the Fed funds rate, which gives them the opportunity and the tools to lower the Fed funds rate, if they need to, when our next recession rolls around. The other way they could do that is simply start selling this stuff back into the market. And what they'll do is they'll sell it back to Bank of America, Citi, Wells Fargo, all of the primary dealers, and then the super regionals. And all those banks will start giving up all their extra reserves, and the bond market will all of a sudden be liquid again. Well, I wouldn't say all of a sudden, but it could be. If they were to liquidate this entire portfolio, I calculate the bond market could absorb about $60 billion a month, maybe $70 billion a month, without much change in the interest rates. So it'd take them a little while to get rid of $4.3 billion, but they could do it. You notice there isn't any more borrowing. There's no pressure for additional borrowing. There's no motivation that I've read in the 11 pages of the last Federal Open Market Committee meetings and their notes. Boy, if you have amnesia or insomnia, boy, I'll that cure it. Anyway, here's the liquidity in the bond market. I suspect that after they raise rates a little more, they'll start liquidating this. So where we are today is people are losing confidence in the S&P 500. I wouldn't give up on it at all. Their earnings are just fine, and there certainly aren't any disasters pending, either here or in Europe. They simply have to adjust. The only major economy that has true structural problems that they might deal with is China. And anybody who watched the Hong Kong dollar get hammered last week, the last bastion of security in that entire Asian market just went away. So that's all for now.